So, can a foreign investor, or a business for that matter, operate or honestly even just hold property in another country without paying a dime in local taxes? I mean, it sounds like the ultimate loophole, right? But expert analyses show us a highly complex landscape. Holding a physical asset like US real estate triggers immediate, absolutely unforgiving tax liabilities if you don't know the rules. Today, we're looking strictly at the data, the underlying mechanisms, and honestly, the hidden traps that foreign investors blindly walk right into. To really unpack this, we first have to objectively define this concept called nexus. Think of nexus as the critical connection or presence within a jurisdiction that establishes your legal and tax liability. It's essentially this invisible, highly mechanized tripwire that determines if an entity has crossed over into taxable territory. And for foreign investors, simply purchasing a piece of real estate instantly trips that wire. It establishes an undeniable physical and economic nexus that permanently alters your operational risk profile. Welcome to our explainer. Today, we are decoding the architecture of compliance. We're going to strip away all the generic advice and the surface-level storytelling, and instead look strictly at the rigid, mechanized layers of international taxation. Our analysis today operates as an engine, focused heavily on how foreign investments and physical assets, specifically US real estate, are structurally treated under current tax law, exposing the true bottom-line cost of non-compliance. Here's the macro to micro analytical framework we're going to use today. We'll start with the US business tax landscape, move into understanding jurisdictional nexus, then the mechanisms of double taxation, qualifications for tax relief, treaty rates and overpayments, and finally, stringent compliance and reporting. Let's jump right in. Section 1, the US business tax landscape. Before any tax is ever levied, we have to ask, how are non-resident business entities and foreign investment structures established in the first place? Well, the foreign incorporation flow is highly mechanized. It follows a very strict cause and effect pattern. Entity selection, then state registration, shareholding distribution, and finally, tax ID acquisition. Now, each single step here isn't just, administrative paperwork to file away in a drawer. It's a structural mechanism that permanently locks the entity into highly specific, inescapable future regulatory and financial obligations. And this reveals a really stark strategic divide emphasized in expert reporting. Operating locally clearly triggers immediate operational taxation. On the flip side, establishing a non-resident holding entity can often bypass operational tax generation entirely. You're just doing informational reporting. But here's the critical exception. The exact moment that non-resident holding company acquires real property, well, that strategic shield is immediately pierced by local tax laws. It violently shifts the entity from mere informational reporting right back into direct, heavy financial liability. Moving on to Section 2, understanding jurisdictional nexus. Let's look at the data through what expert reports refer to as the neighborhood analogy. Imagine you have business A and business B. Both possess completely identical operations, yet they carry vastly different tax burdens. The root cause? Literally just their physical address. You see, in highly complex regulatory systems, there are tens of thousands of overlapping state, county, and municipal tax jurisdictions. Two identical assets sitting just a few meters apart can face entirely different liabilities, purely because of these invisible borders. But, the exposure goes even deeper than that. While physical assets like US real estate create an unavoidable, permanent physical nexus, digital sales create invisible tax exposure directly in the buyer's jurisdiction. If you're sitting in one country and selling digitally to a buyer in another, you are automatically generating overlapping exposure. The assumption that you only need a brick-and-mortar presence to be taxed, that's an absolutely obsolete interpretation of modern regulatory law. Which brings us to Section 3, the mechanisms of double taxation. Because global revenue streams, whether derived from digital software sales or rent from physical real estate, inevitably cause overlapping financial claims from completely different sovereign governments. Analytical reports point to some distinct patterns here. Income is strictly sourced based on where the physical asset, like a piece of real estate, is physically located. Simultaneously, the investor's home country might enforce its own global taxation laws on that exact same rental revenue or capital gain. The mechanized reality is that multiple jurisdictions are engineered from the ground up to attempt to tax the exact same dollar. Section 4, Qualifications for Tax Relief. So how do regulatory frameworks solve this inherent conflict? We have to look at the strict qualifications for tax relief. There are 4 absolutely non-negotiable tests mandated here. The foreign tax must be directly imposed on the taxpayer, paid or accrued, a legal and actual liability, and recognized as a compulsory income tax. Listen, if a foreign investor or entity fails even a single one of these criteria, the regulatory framework systematically and automatically denies the relief. No exceptions. That third test forces a crucial, really high-stakes question. What exactly defines a legal and actual liability when you're assessing global tax credits? There's this massive implicit assumption among foreign real estate investors that simply writing a check to a foreign tax authority automatically guarantees you a credit back in your home country. Well, expert analysis proves that assumption is entirely mathematically false. The non-obvious detail is this: credits are legally invalid if the tax amount could have been reasonably refunded, credited, abated, or forgiven by the foreign authority. Think about the direct cause and effect here. If you lazily overpaid a foreign government, or maybe you just missed an exemption filing, your domestic tax authority is not going to subsidize your failure to optimize your footprint. You eat that loss, period. Let's head into Section 5, treaty rates and overpayments. 30%. Let that number sink in for a second. This brilliant yet honestly brutal number illustrates the standard U.S. statutory withholding rate for foreign entities. It's a fixed, default penalty rate automatically applied to gross income when compliance is ignored. And in the context of real estate, similar severe statutory mechanisms exist, most notably FIRPTA, which forcefully withholds up to 15% of the gross sales price of a property. Not just the profit, mind you, the gross sales price, the very moment a foreign investor attempts to sell. The statutory rate is the default. It's rigid and it is brutally high. The treaty rate, however, is a reduced rate established through bilateral international agreements. But here's the really actionable insight. You are legally required to actively invoke that lower treaty rate. If you just passively accept the default 30% statutory rate, your claim for domestic tax relief on that excess amount is entirely invalidated. Why? Because it was never actually a compulsory liability. You basically volunteered that money. The burden of proof lies entirely on you, the taxpayer. You must exhaust all administrative remedies through a very rigid sequential process. First, apply the treaty rate. Second, submit a formal withholding statement or certificate. And finally, if you still overpaid, file an amended return for a foreign refund. You have to definitively prove you exhausted all practical remedies to minimize your liability before you can ever claim a domestic credit. This reality anchors our entire analysis into the final phase, Section 6, Stringent Compliance and Reporting. This is purely about avoiding catastrophic financial penalties through total, uncompromising operational readiness. Now, we have to clear up a massive structural misconception right now. Compliance does not always mean paying out money. There is a very distinct line between an informational return, which solely tracks transaction types and triggers absolutely zero financial payment, and a tax return, which calculates actual financial liability. Properly structured, an entity might simply file informational returns year over year to maintain absolute, pristine compliance. These are your non-negotiable compliance anchors. Beyond standard income reporting, foreign investors face highly specialized, severe requirements. The most critical one, FIRPTA, the Foreign Investment in Real Property Tax Act. If a foreign person sells U.S. real estate, FIRPTA mandates that the buyer must withhold up to 15% of the total sales price. Again, regardless of whether the seller actually made a profit. To prevent having their gross capital locked up, the foreign seller has to proactively apply for a withholding certificate from the IRS before the sale even closes, just to prove their actual tax liability is lower. Alongside FIRPTA, FATCA disclosures demand total transparency for foreign financial accounts. These are absolute, mechanized traps for the unprepared. The ultimate stakes are purely mathematical. According to expert analysis, the cost of non-compliance can be 3 to 10 times the cost of actual compliance. This isn't just a casual observation, folks. It's a proven, documented cause and effect relationship. Ignoring structural tax laws or FIRPTA withholding mandates doesn't just result in your standard back taxes, it forcefully triggers compounded penalties, locks up your operational capital, and causes severe business drain. So the crucial point we're ending on today is this. As global tax architectures constantly evolve and property laws tighten, is your foreign investment structure actually built for proactive compliance? Or are you blindly exposed to overlapping liabilities and massive statutory withholdings? Understanding these strict mechanisms is literally the only way to protect your capital. Keep analyzing the structures around you, and I will see you next time on The Explainer.